Who's ready to talk about risk management? Awesome.
Where's the enthusiasm? Risk management is fun.
My name is Anestis Arampatzis, and I'm the moderator. But first, I will let our guest talk a little bit about themselves and who they are.
Hey, everybody. Joe Ziolkowski, CEO and founder of Relm Insurance. Relm is a fully regulated commercial insurance company domiciled in Bermuda. We've been insuring companies across the Bitcoin and digital asset ecosystem since 2019. We provided coverage to companies operating in more than 35 countries around the world and continuing to build resilience within an industry that we remain fully committed to.
Hi, guys and ladies. My name's Greg Foss. I am a 30-year veteran of the traditional finance markets, managing risk on both the buy side, which is the hedge fund industry, and the sell side. I started my career as a high-yield bond trader at TD Securities in both Canada and New York. I want to thank you for being here. I'm a probabilities guy, and my over-under was way lower than the number of people that are in the audience today. So thanks a lot for being here. I hope to... I forgot to say something. I'm a proud father of 3 kids, and I'm doing this for the kids, all right? So thanks for being here.
Yeah, hello, everybody. Thanks for coming. It's a great energy in this room. I can feel it up here. I'm John Devine from BlockFills. I'm an institutional market maker serving hedge funds, Bitcoin miners, proprietary traders, and whales in digital assets and Bitcoin, of course. My career began as a market maker in precious metals markets, interest rate markets, and crude oil and natural gas before crypto. But now I'm here to help share some education and help with execution on risk management and real yield strategies.
And on my side, I'm the co-founder of Sphinx Bitcoin, a derivatives hedge fund on the space, and the co-founder of Centaur Markets, a structured product desk on the space. Before that, I used to be the global head of trading for cotton for StoneX. Okay, let's begin.
Hold on. What? Sailor who? Michael Saylor, fuck yourself. They're all over here and they're staying here. Thank you for coming, everybody.
Awesome. So one of my favorite things to say is that risk management on an individual basis in Bitcoin is a vote of confidence for the broader market. The moment the individual is getting stopped out or stop getting margined, this is the moment that the markets will stop selling out and volatility will ease. And with that being said, I'm going to address my first question to Greg. Has a long-term history of trading risk assets, and he spent his career in the middle of the great financial crisis trading credit strategies. Looking back at that time and now, what are some things and some similarities you saw between that crisis and the past 18 months?
Yeah, so great question. Every single financial crisis has a similarity that, firstly, it's because of leverage, okay? And then secondly, that leverage gets kicked upstairs to the final debtor, which is the sovereign nation. So I started my career in 1988. I'm a Canadian, studied engineering at McGill, but then went down to the USA and had the opportunity to study an MBA at Cornell. And I was blessed to be schooled in this great country, but went back to Canada and I worked for Canada's largest financial institution. This is a true story. I started working during 1988 where the world was wrestling with the Latin American debt crisis, okay? And my first project, working directly for the CFO, was to price the Latin American debt portfolio of the Royal Bank and then also determine the Brady plan option that we were going to take. Treasury Secretary Nicholas Brady had proposed a solution to the LDC debt crisis called the Brady bonds, okay? And the first country they did it with was Mexico. But I did a quick back-of-the-envelope calculation based on the trading prices of all the Latin American debt, and I quickly realized that Royal Bank of Canada, the largest financial institution in Canada, was insolvent. And I had just gone through 6 years of schooling, paid a lot of money to realize that the fiat Ponzi was built on sand. But I went to my CFO and I go, Emil, we have a big problem. And I swear to God, I love the man. He goes, I know, don't tell anybody. And I'm just like, firstly, I can't go to the Wall Street Journal and tell them. I'm a young kid, I got school obligations, loans, but the other thing was, it was no different than any financial institution in any other part of the world. The entire banking system was insolvent on a mark-to-market basis because of credit risk to Latin American and other developing countries. Where are we today? The same thing with the regional banks in the USA, not because of credit risk this time, but because of interest rate risk. And we could get granular on that basis, but here's what I want to leave you with. The fiat system is based on a transfer mechanism called commercial banks, which is inherently risky because of the leverage in that system. And every single financial crisis, the banks are all insolvent. Royal Bank of Canada was no different. How do they solve it? Well, they're too big to fail. They kick the risk upstairs to the governments, and now that becomes a sovereign debt crisis. So that is the risk in the markets right now, is the sovereign debt nations have become too indebted, and you will never solve the debt spiral, hence Bitcoin. I hate to ruin, that's the conclusion. I can leave now, okay? Own Bitcoin because of the sovereign debt crisis that always starts in commercial banking and then get kicked upstairs. Latin American debt, long-term capital, great financial crisis, COVID, and now commercial real estate and interest rate risks on commercial banks in the USA. Simple math. Thanks.
And as Greg said very rightfully, what we came to realize also in our space is that the majority of the people consider price to be the major risk factor in the industry. But the reality is that the major risk factor is actually counterparty risk, not price. So Bitcoin and owning Bitcoin is very different to having exposure to other counterparties. Moving into John, though, John, you have great experience trading derivatives and options markets, and you spend the majority of the day talking with counterparties that use derivatives and options to manage the risk. Looking back at the last 18 months, what were some things that some teams did correctly and it worked out for them, versus some things that teams did wrong and they're not with us now?
Certainly. So I think I want to start with your first point there on counterparty risk management. So when we think about leverage, we think about the ability to optimize returns, but there's incredible risk associated with leverage. I like to think about leverage as an opportunity to manage counterparty risk. So what I mean by that is, if you work with a professional trading company, you can put on a position for 25% margin, let's say for a rough number. And some people will look at that as an opportunity to over-leverage themselves and get into positions that they cannot cover. But really what you can do in that scenario is utilize leverage as a way to self-custody 75% of your position and utilize your trading firm with only 25% exposure. So I think the people who did really well managing counterparty risk in this last cycle, where of course we saw some major names go underwater, they were utilizing leverage properly in this regard. And so I think as we've learned and as we've seen from some of these blow-ups across the industry, more and more people are beginning to open their eyes to leverage is really an opportunity to manage my exposure to a counterparty. So that's a big takeaway that I think the industry has had to learn a hard way in the past 18 months or so. But then now thinking about who did really well, not just managing counterparty risk, but managing price risk. And I think it's people who took the time to understand the purpose and the point of why certain derivative instruments were invented. So I'll talk about options real briefly. Options are, of course, very popular tools to speculate and to use leverage improperly, but they're also a huge opportunity to use the instruments as they were intended to do. I'll give you an example. Let's say you're a Bitcoin miner, or you're any entity that has Bitcoin on the balance sheet, instead of just allowing Bitcoin to free float with the market, you can utilize options markets to create electronic cash flow. And I'll say electronic cash flow because Bitcoin is electronic cash. And so what I mean by that is I own Bitcoin. I can sell a call option. A call option is the right to own an asset at a certain strike price at a certain expiration date. If I own Bitcoin, I can sell the optionality to somebody else in the market to buy my Bitcoin at a higher price at a later date and time. And in doing so, I can create a yield. And now I can create cash flow from my Bitcoin balance sheet. Now, let's say I take a percentage of my balance sheet and apply that, and we call that a covered call. Now, let's say I take a percentage of my balance sheet and execute that strategy. I can go even further. I can take another percentage of my balance sheet, sell a call option as I just described, but then I can finance by selling the call option. I receive a yield day one. I can then take that yield and buy protection. We talk about protection in options markets as put options. Put options are the right to sell an asset at a predefined strike price at an expiration date in the future. So I'm selling upside exposure against my Bitcoin balance sheet, and I'm using that to finance insurance on a price I can ensure that I can sell the asset at. And I call that a zero-cost collar, when you're selling a call and taking the proceeds to buy a put option for free. So I think there's 2 points to wrap up there. Counterparty risk management can be utilized via leverage, where you're only posting a certain percentage of your Bitcoin to a trading counterparty and you're self-custodying the rest, and then further utilizing derivative instruments as they were intended to be used, which is to manage risk on price of the asset that you hold on your balance sheet.
Excellent. And the key takeaway here is essentially utilize leverage to minimize counterparty exposure, not to increase a position that you cannot ultimately manage.
Exactly, and I think that we had, this is a very common thing with market cycles. When markets start to go straight up, people start to say, wait a sec, this whole leverage concept, I can amplify my returns, but they're not really fully understanding the risks associated with that. And then it takes the crash for people to say, wait, how can I actually use leverage to defend myself in the marketplace from counterparty risk?
Excellent. So switching now a little bit and talking about a different type of risk approach. Joe, Relm Insurance bridged the long gap between emerging industries and traditional insurance players. Which are some underrated risk factors that, if proactively managed with insurance policy, believe could be of a big help at the time of a crisis?
Yeah, so it's a great question. And I think John just gave a really great example of how you can manage kind of the pricing exposure arising from counterparty risk. But there's a, when you're looking at non-pricing or non-speculative risk, one of the easiest ways to manage counterparty risk is through insurance, right? And it's not sexy, but when you look at any industry, insurance is the bedrock of scalability. Insurance is the way to hedge against counterparty risk. And when you're looking at the idea of utilizing insurance in a time of crisis, we have unfortunately too many examples in the last 8 months of companies that have been maligned arising from their reliance on counterparties. I mean, if you look at the domino effect in the wake of FTX, imagine being an independent director for an asset manager who had 90% of their assets custodied with FTX. Now you're in a position facing liquidation. You're in a position facing investors who are, rightfully pissed off that a substantial portion of their assets is now evaporated. Who are they going to come after? They're coming after the individuals who are charting the course for these companies. And I think when you talk to a lot of the people who are sitting in director positions for a lot of the companies that we provide insurance to, they're informed. They're sophisticated. None of these people are taking their positions on a board cavalierly, but what you can't anticipate are these unforeseen circumstances, and the only real source of protection when things don't go as planned, other than your personal assets, is to tap into an insurance policy for some protection and financial recovery.
And to add on that, you know, having traded every financial crisis from the Greek banking crisis into the current one, the one thing I realized is that it's not the good traders that end up being alive and making money. It's the good risk managers. Bingo. And most of the time, risk management starts before the issue shows up. And many times, you know, people will say, why do I need to pay for that insurance premium or for that option premium? But the reality is that I've never met an entity that went out of business for making less. I've met many entities that went out of business because they tried to make more. So this is a question for all three of you. Looking back the last 18 months, what are some things that you would do different in your business? Or what are some things that came out of left field and surprised you, but will be now in your monitor and focus as you prepare for the next crisis?
I'll take the first one. So we insured FTX US. And as you can imagine, we didn't see that one coming. Now, I will say we underwrote FTX thoroughly, FTX US thoroughly. You know, we had audited financials. We had access to a ton of information. We avoided Alameda. We avoided FTX.com, FTX trading. But, you know, I've been asked the question, well, you know, you guys must have missed something there. I don't think we did miss something on FTX US. And if we had to do it all over again, we probably would have made the same decisions based on, you know, they're one of the most liquid clients we probably had in our entire portfolio. So, you know, when you look at our approach to underwriting, counterparty risk has been a factor in it since we wrote our first deal back in 2020. When you're underwriting a company for D&O insurance, you're looking at financials, you're looking at cap tables, you're looking at investors, you're looking at Ds and Os, you're looking at products and services, you're looking at compliance infrastructure, and you're looking at their tech stack. So while it would have been great to have avoided, you know, the situation with FTX US, I think what it has done, which has been great for the sector, it's short-term pain, long-term gain. People in this industry are now more sophisticated. They're more risk-aware. And for us as an insurance company providing coverage to hundreds of companies within the space, you know, we're seeing a more mature crop of companies coming to us for insurance. And I think that's a great outcome from something that's obviously been really unfortunate.
Hey, Big Sean Harris and his dad just entered the room. Thanks for coming, brother. Professional basketball player from Europe who's a Bitcoiner. I suggest you guys follow him. I love you, Sean Harris. So, you know, we could get really philosophical and granular on how to manage risk and what surprises you. All right, let me be very clear. All I bring to the table is 35 years of mistakes. But I have never let any of those mistakes bring down my business or my trading career. So if you actually think that you're going to go through life as a trader by making money on every trade and just ringing the cash register, you're managing risk wrong. You got to manage risk by focusing on your losers, not on your winners. Okay? So the best traders I've ever met in my life are women. Why is that? They probably aren't as headstrong as us dumbass, fat, white guys like me, all right?
Don't paint with such broad strokes.
But here we go. Women are smart, better traders because they accept the situation and then they manage themselves out of it. They manage the situation that they didn't see coming, but they don't add to the problem. They don't double down.
Caroline Ellison.
All right? They do not double down. Why are computers sometimes much better traders than the human?
No emotion.
No emotion, correct. So all I would say is what has surprised me in the last few years or the last year? Nothing, because I don't try and predict the future. I take the information in the here and now. I find assets that are stupid cheap, and I buy some. And if the price goes lower and my thesis has not changed, I add to that position. But if you are not big enough to admit that the information has changed and your thesis is now invalid, You might as well wheel yourself off of the fucking trading floor. You don't belong there. And I've seen plenty of guys, no kidding. I've seen 2 guys wheeled off the floor from heart attack. Wheeled off the floor. This is not fun. Trading is a horrible business. Yeah. You want to be an asset manager? You've lost your mind. Okay? You have to manage money like it's your own. And people take that for granted. It is an impossibly difficult business. And you have to take advantage of the tools that exist in the business to manage risk properly. So I'm going to leave you with this. The only wrong exposure to Bitcoin is owning 0. The most ridiculous exposure to Bitcoin is being shorted. And if you haven't figured that out, you failed mathematics. And I'll call out anybody on Wall Street who says it differently, that they haven't done the research. So where does it start? With education. You can educate yourself to prepare yourself for what is coming, which just means evaluate your thesis with every new information that hits the news wires. Don't be Peter Schiff. Peter Schiff's gold fund, if he had allocated 1% of his gold fund, which should have been a sound money fund, not just designated as a gold fund, when he first was introduced to Bitcoin, it was $10. So it's up 3,000 times since he was first introduced to Bitcoin. And how did he manage his risk? He denied it success. Well, that 3,000 times on a 1% position, you can do the math and realize he would have been the best performing gold fund in the history of gold funds. Instead, he's just a turnip. Don't be a turnip. Manage risk properly. Thank you very much.
Yeah. Well, you can't say it really much better than that, Greg. So, you know, I think about the last 18 to 24 months and what, you know, what I could have done differently, or what our business could have done differently. You know, I look in this audience and I actually say, this is what I could have done differently. Be more vocal at conferences and at gatherings and in other ways to communicate. I spent most of my career in a risk chair, and quite honestly, we don't venture out very far. It wasn't really until I got into Bitcoin, I started going to some conferences and some meetups, and I saw the conversation so dominated by, you know, the prospect to make a lot of money, okay? And I think that's great, and there needs to be a hype, and there needs to be a reason to get excited. But looking at this audience right here, I realize that, you know, risk management needs to be a focal conversation point at every Bitcoin conference and digital asset conference. There's not enough emphasis placed on this topic, and I'm actually very encouraged to see a full room here. Probably helps that we have had some correction in the market and people are focusing on this. But that's what I would do differently, because at BlockFills, where I work and I provide liquidity to institutions in the marketplace, I saw the best performing, I'll take Bitcoin miners, for example. The best performing Bitcoin miners applied risk management strategies, some of the ones I talked about earlier, and especially the using leverage as counterparty risk management, as opposed to speculation and enhanced yields. So yeah, that's what I would do differently. I'd get out on stage more, talk more. I think this shows there is a demand for this conversation. So, you know, that's would be my adjustment.
And if I could just add, thank you guys for coming, because honestly, it is a education process, and this is sort of like taking Bitcoin to the second layer, okay? But in terms of managing risk. Certainly. And I love insurance. I've spent my career in credit, which, as you know, credit default swaps are a form of insurance. Yeah. Ultimately, everything boils down to risk management. There is always a price for everything. Yeah. Don't ever convince yourself that there's never a price. You have to be prepared for any price and how you would act under that situation. Sorry to interrupt.
And if I could just say one more thing here. So you know, as we see the progression of Bitcoin, you know, we see the adoption curve of Bitcoin. I think this next big step in the adoption is for many more companies and entities to start putting Bitcoin on their balance sheet. That has to happen. Payment providers, actually, you can just go broad spectrum. Like there should be a treasury manager at every single company thinking about, should I have some Bitcoin exposure on my balance sheet? And I think for that really to happen and solidify and keep this adoption curve going, this conversation makes that possibility real. And I'll leave it at that.
Yeah, no, and it's a great point, John. And I will say, as a fully regulated commercial insurance company, we do hold Bitcoin on our balance sheet. So 100% aligned in that sense. And I want to get Greg a T-shirt that says, "I love insurance." I think it's a great idea. But as it relates to the sensitivity for risk management, I mean, that's the first hallmark of a maturing industry, right? It's not unique to the Bitcoin economy or the digital asset space. It's unique to any emerging sector. When the companies operating on the fringe start caring about risk management, when they start making investments into something like a enterprise risk management framework and governance, risk, and compliance, I mean, this is going to make the pathway toward mainstream adoption and institutional adoption quicker.
That's right.
And as an operator sitting in the audience, when you're trying to figure out ways to manage risk, your sensitivity toward risk management is going to put you in a very unique category when it comes time to be underwritten for professional indemnity coverage or cyber insurance or custodial insurance or directors and officers liability. So the fact that you care, I think, is a major step in the right direction, and it's a huge differentiator from a lot of the companies that are currently out in the market.
And as all of you more or less implied, risk management begins by acknowledging the existence of risk. Because on our human nature, we are pretty good into taking risk to zero, especially risk that's actually very small probabilities. And one, terrible example is, whenever you get on a plane, we take the risk probability of actually dying because it falls to zero. So humans by default are very bad in pricing little probability risk. So actually trying to focus on acknowledging what is the risk on our industry and then defining our strategy based on our goals, but not the situation that we are in, I think is a big step into actually managing risk properly. I don't know if any of you have to add anything, but.
I would just add, and I love, it comes down to mathematics. That's why I love Bitcoin, right? That's why I was a credit trader. There's very little subjectivity in pricing bonds. It's a contract. There's no subjectivity in the cash flows and the contractual obligation. But always manage your life as a probability. And on that basis, there are very few things that are 100% certain in finance particularly, except this one. It's mathematically certain that fiat will continue to debase on an accelerated basis. Yeah. That's 100% certainty. I can prove it to you 6 ways till Sunday. Protect yourself with that certainty with other hard assets. Bitcoin is the best hard asset in the race. If you own zero, apply at Peter Schiff's firm.
Guys and girls here, look, I can be a good steward of this marketplace by contributing to the education conversation. If any of you see me the rest of the show, come up, talk to me. I'm happy to get into it. I'm John Devine at BlockFills. Feel free to find me however you can. Even working on some Twitter stuff at I am John Devine if you want to find me there. But rest of the show, if you see me, please stop me and I'll get into some strategy with you.
Yes, and to close off, the key of a 30 minutes conversation about risk management is not to learn about risk management, but is to understand the importance of digging into it, what it means. So, there are a bunch of professionals here. Try to reach out to them, avoid personal leverage, and if everyone does the job correctly, Bitcoin to 100,000.
Let's go, baby.
That's way cheap. You're way low. Thanks for coming, guys. I really appreciate it.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.